you almost certainly own something made by Nike: a pair of shoes, a hoodie, a jersey. It is one of the most recognized brands on the planet, in over 190 countries, worn by the greatest athletes in history. And right now, you can buy a piece of that company at the cheapest price since 2014. Nike hit an all-time high of $179 per share in November 2021. Today, it trades at around $42. That is a 75% drop from the peak. The question is simple: is this a generational buying opportunity or a value trap? I'm going to give you my honest take. To understand where Nike is going, you need to understand how it fell so far. It starts with a series of strategic mistakes made under the previous CEO, John Donahoe. According to Tom Nikic, senior research analyst at Needham & Company, the prior management regime completely misjudged the sneaker market, period, the importance of product development, the importance of good wholesale relationships, the way that customers shop, what customers look for. Nike's big bet under Donahoe was a direct-to-consumer strategy, cutting out retailers like Foot Locker and selling directly through Nike's own stores and app. The idea made sense in theory: higher margins, more control. But in practice, DTC wasn't able to offset the wholesale business, and Nike's product mix stopped resonating with cost-conscious consumers, leading to price cuts, margin compression, and innovation challenges. Then the macro environment turned ugly. Tariffs hit Nike's manufacturing base in Vietnam and Southeast Asia hard. In Q3 fiscal 2026, higher tariffs alone accounted for 300 basis points of gross margin pressure in North America. And then there's China. Greater China was considered Nike's largest international growth driver, but local brands like Anta and Li-Ning surged in popularity, and New Balance, with its dad shoes becoming a popular fashion choice among young consumers, took a significant bite out of Nike's lifestyle sneaker business, reaching $9.2 billion in revenue, a 19% year-over-year jump in 2025. The result? After hitting its all-time high, Nike's stock fell 29.8% in 2022, 7.2% in 2023, 30.3% in 2024, and has continued falling in 2026. 4 straight years of losses. That does not happen to iconic brands very often. Let's look at where the company actually stands right now, because the numbers tell a complicated story. In fiscal Q3 2026, revenue came in at $11.3 billion, roughly flat year over year. That is actually progress. Fiscal 2025 saw a full 10% revenue decline. So the bleeding has slowed. But profitability is still under serious pressure. Earnings per share fell 35% to 35 cents. And net income dropped to $520 million from $794 million a year earlier. Gross margin contracted for the 6th straight quarter, falling to 40.2%, and the guidance didn't help. Nike expects fourth quarter revenue to decline 2% to 4%, with Greater China revenue falling approximately 20% as the company flushes out excess inventory in that market. That last piece of guidance is what triggered the most recent 15% single-day collapse. Goldman Sachs, J.P. Morgan, and Bank of America all downgraded the stock on the same day. On paper, this looks bad. But here's where it gets interesting. Here is my honest take. I think Nike at $42 is one of the more compelling long-term setups in the entire S&P 500 right now. And I'm not alone in that view. Let me give you 5 reasons. 1. The brand is intact. Nike commands approximately 39% of the global athletic footwear market with over $46 billion in annual revenue. The brand has not broken. It has lost momentum. Those are very different things, and momentum can be rebuilt. 2. The new CEO is the right person. Elliott Hill is not a turnaround consultant parachuted in from outside. He spent 32 years at Nike, built many of its most important partnerships, and came out of retirement specifically to fix this. He recently bought over $2 million worth of Nike stock at current prices out of his own pocket. CEOs do not do that unless they genuinely believe in the recovery. 3. The smart money is buying. Apple CEO Tim Cook purchased 25,000 shares of Nike at around $42 per share. Tim Cook buying your stock is not a small signal. These are two of the most respected executives in American business putting their own money on the line at these levels. 4. The wholesale recovery is real. Wholesale revenue is trending back towards 60% of the mix, and the running segment grew 20% in Q1 2026. The core athletic business, the part that actually defines the Nike brand, is growing. The problem is lifestyle and China, which are being actively reset. 5. The valuation and dividend. Wall Street's consensus price target is around $62 per share, implying roughly 41% upside from today's levels. Nike has a 24-year dividend growth streak and a dividend yield now approaching 4%. The bull case from analysts suggests Nike could generate $4 in EPS by fiscal 2028, implying a potential path back toward $100 per share. That would be a 140% return from today. I want to be straight with you because this is not a risk-free bet, far from it. CEO Elliott Hill himself acknowledged the turnaround is taking longer than he expected, and management has guided for sales to remain negative well into fiscal 2027. Patience is required, and patience has a cost. On running, Hoka and New Balance have captured mind share among younger consumers that Nike may struggle to reclaim. Brand erosion among the next generation is the one risk I watch most closely. If 25-year-olds stop wanting to wear Nike, no CEO can fix that, and China remains deeply uncertain. A projected 20% drop in Greater China sales is not a small correction. It is a structural reset of what was once Nike's most exciting growth market. This is not a stock that is going to recover next quarter. Anyone buying Nike today needs a 2 to 3 year horizon minimum. Nike is not a broken company. It is a great company going through a very painful period, one it largely created for itself through bad strategic decisions that are now being unwound. At $42, you are buying one of the most powerful consumer brands in human history at a 12-year low, with a CEO who has his own money in the stock, with Apple's Tim Cook buying alongside him, and with Wall Street seeing 40% to 140% upside depending on how the recovery plays out. Is it guaranteed? Absolutely not. Turnarounds take time, and Nike's problems are real. But if you have the patience to wait 2 to 3 years, I think the risk-reward at this price is genuinely attractive. You are being paid nearly 4% in dividends to wait, and you are buying at a level that already prices in a lot of bad news. As Warren Buffett once said, "Be greedy when others are fearful." Right now, almost everyone is fearful about Nike. That is exactly when the best opportunities tend to appear. Hit like if this changed how you think about Nike, and subscribe for the next deep dive.